Good evening, everyone. I'm Krishna Karwa from iFAST Financial India Private Limited. A warm welcome to all of you on this call. In today's session, the topic will be allocating debt mutual funds in one's portfolio amid the current scenario. Now, before I begin, let me highlight the three key trends that have been in the spotlight in terms of the debt market. Number one, after several defaults by the ILNFS, DHFL, ZA Entertainment, and more recently the Future Group, debt investors have been largely risk averse in nature. The second key trend is that inflation has been more often than not hovering above the RBI's upper tolerance band of 6%, which means that not only the possibility of future rate cuts is bleak, but also a lot of debt mutual funds have been witnessing immense volatility. Thirdly, in light of the government's borrowing program for debt securities, yields are also witnessing upward pressure. So keeping all of these factors in mind, initially, I would like to call upon two advisors from iFAST, Mr. Sridhar Sattiraju and Mr. Dheeraj Shetty, to get their views on some perspectives in this regard. So good evening, gentlemen. I'll start with Sridhar. He is a certified financial planner and an investment advisor with iFAST Global Markets. He has been in the wealth management industry for over 25 years and is based out of Hyderabad. Mr. Dheeraj Shetty, on the other hand, is also an investment advisor and specializes in retirement planning, tax planning, and risk management. So on that note, let me first start off by asking Sridhar, in the current scenario, which debt products, what's your take on the debt allocation in one's portfolio, and how are you helping your clients navigate risks and at the same time derive some alpha?
Thanks, Krishna, and welcome, Dheeraj. Thanks to all the panelists. At the outset, yes, the question is always what is the right amount of debt in the portfolio, and what should be the vehicles for playing that space. In my book, it has always been that asset allocation plays a big role in any portfolio. And my experience tells me that over the period of last 20, 25 years that I have been in this industry, any amount of risk taking that you take, it pays off more in your equity markets or in the business segments that one is in. But any amount of risk taking in the debt space, it's not worth it unless you know very well what you're getting into. So what I'm trying to say is that, quality of debt matters more than anything else. And therefore, in cherry picking the debt portions in my clients' portfolios, I have always focused on high quality debt, which is anything about AAA and above, and nothing in the below space of AA and below. At the same time, a lot of accrual funds and any other low-hanging fruits that are available without taking extra risk. So these are the vehicles of debt in my asset allocation for the debt portion. And so far, we have been managing it well in the sense of ducking all the DHFL, Z, ILFS kind of fiascos being avoided in the portfolio. Yeah,
all
that's
right.
it. Yeah.
So Dheeraj, your views on this?
Thank you, Krishna. First of all, congratulations to Team iFAST for the incredible initiative. I feel it will add a lot of value. Sridhar sir, welcome. Panelist, an absolute pleasure and honor sharing this stage with you all. For us at Dheeraj Shetty, we are investment and retirement advisors working predominantly with salaried executives, corporate lawyers, and doctors. So when you look at these category of individuals and families, they are completely risk averse, right? So when everything came out with what happened in 2019 and 2020 with all the debt funds, it was a challenging time for us as an advisory firm as well. That being said, debt in every family's portfolio to a large degree is a must. The exact proportion of debt truly depends on the family and the family's asset allocation based on their requirements and based on their risk appetite, risk tolerance versus risk appetite, right? So these are definite, debt is a definite part of this, and you have to focus on high quality debt of the rating of the papers and sticking to the shorter durations and the accrual funds. So conclusion for me is when families get into equities, right, they are aware that they are getting into an ocean and there will be currents. But when a family is looking at debt, they're looking to get into a river for a nice swim. They are not expecting currents, they are not expecting volatility. So we need to understand that when we're working with these families.
Absolutely, Dheeraj. Well pointed out by both of you, in fact. So on that note, Dheeraj, I'll start with you. Which kind of fixed income products are your clients actually flocking to lately?
Well, earlier we had several different categories of debt, but in the last 2.5 years, ever since credit ratings started, we saw credit ratings having issues in 2019. Right from then, from that point on, we have been a lot more conservative. Predominantly, our clients are looking at the ultra short funds, they're looking at liquid funds, and they're also looking at arbitrage funds. Now, while we have to keep intact and keep this in mind, we have kept it in mind because inflation is rising. So governments will have to do something in order to curb inflation. And the only option there is to increase those interest rates, which will negatively impact these longer duration funds. So we've kept it simple. We've also looked at a lot of bonds through RECs, through PSUs, and PPF is always a phenomenal option because of the tax benefit and the EEE option.
Absolutely. Sridhar, what are your thoughts on this?
Yeah, I would tend to go with what Dheeraj just mentioned. Like I mentioned, debt should not be used for risk taking. Reserve it for other asset classes. So on that leaves me with all the low hanging fruits, the contractual deposits of senior citizen schemes and PPFs and all. Arbitrage funds is again looking attractive at this point. FMPs, which are of real high quality AAA, that has always served a good purpose. Apart from that, taking a lot of tax-free bonds exposure has helped the clients to both take a little duration risk, at the same time play on the the kind of underlying appreciation that's happening in the debt instruments. Beyond this, I have not ventured much into any kind of complicated debt or commingled debt portion, because one should sleep well by taking the debt. And if there is a cash flow problem that is not solved by taking debt exposure, let's not overcomplicate the portfolio. That's my view.
Correct. So thank you, gentlemen, for setting the tone. And on that note, it's time for me to invite our esteemed panelists to this discussion. So I'll introduce three well-known names in India's debt mutual fund space. Mr. Suyash Chaudhary, who heads the fixed income division at IDFC AMC. Mr. Dhaval Dalal, who heads the fixed income division at Edelweiss AMC. And Mr. Chintan Haria, who heads the products and alternatives division at ICICI Prudential Mutual Fund. So welcome to all of you, and we look forward to hearing and understanding your perspectives on a wide variety of fronts as we go along. So Chintan, my first question is to you, and it is in the context of credit risk. At the outset, I did mention that investors are reluctant to invest in low quality debt papers. But having said that, there have been a few isolated incidents in the past, and it's not been all that bad at all when one looks at it from a holistic point of view. So what is your take on the credit environment in India at this point? And more importantly, what lessons have AMCs learned, and how are they now making their risk management processes better?
Good evening, everyone, and thank you. A big hello to all the panelists as well. It is the first time that I'm doing a panel with the stalwarts in debt, so it's my absolute pleasure. I've done many on equity. But to answer your question, yes, 2018-19 have been great learning curves for the entire mutual fund industry. And the good part is that after every learning curve that happens, the industry only grows bigger because necessary checks and balances are put in place to ensure that scale management for the large audience or investor audience is also taken care of. Especially if you look at it today, the requirement for investors on the debt side and the fixed income side is increasing by the day. People are saving a lot more as we grow GDP from 3 trillion to 5 trillion. There is going to be more savings, and mutual funds are going to be at the cusp of that growth story. And whoever has put good risk management practices will definitely benefit. When we started our journey in somewhere in 2012-13 in terms of building a good credit team, we were very clear that it is to be a process across the board. And since then, the processes have helped us. We've had speed breakers, no accidents, but the processes were very simple. It was at different layers. First is you do not have concentration of portfolio in any one particular security. Neither do you have concentration at the group level. The authority to give credit is not in the hands of any one person. It's an approach wherein the entire senior management team of CEO, CIO, the fund manager, and the risk team is involved. And more importantly, the sourcing team, the appraising team, and the disbursal team, all three are different. So I think these checks and balances were already in place with us, and that has helped us. Also, what has helped us is the fact that whenever we were lending, there was a lot of pressure, of course, from sales that we need the highest YTM. But like it was being mentioned, I think Sridhar sir mentioned that in debt, return of capital is more important than return on capital. And hence, we would probably want to be safe rather than sorry. And that approach helped us in the bad times, because even though our YTMs used to be much lower earlier, at least it avoided defaults and people had their capital safe. So I think the learnings are there. All of us, or the entire mutual fund industry, is working towards ensuring that we grow for the benefit of investors. And I would sincerely hope that someday we are able to say that, much like US, the mutual fund industry is managing more money than the banking system in US. Thank you.
Absolutely. So, Dhaval, would you like to add to that?
Yeah, sure. From our perspective, I think we believe that the credit is an integral part of the bond market. In the global markets, the exposure and the growth of credit is going hand in hand with the growth of the economy, because the credit market tends to provide some of the risk capital which is required from the investor's perspective to go in and set up industries and make sufficient kind of investments to grow the GDP. So yes, I think India also had initial start about investing in credit. And the recent episodes have been a little bit of a setback for the industry. But I'm very, very confident that at some point of time, industry and market participants will get together and will try to figure out what went wrong and whether this model requires any kind of fixing. I believe that if we all apply our mind and figure out how to revive this model, definitely, then the credit can become an integral portion of the bond market once again. And that will in turn help investors in future. I also believe that the recent episode has taught us the importance of having liquidity in the portfolio of credit funds, because it's not the credit or the defaults that have been a significant amount of setback, but it's about the liquidity of the instruments. So I believe then if that is the case, then perhaps we can change or tweak the model and perhaps come out with a slightly robust model that addresses the liquidity concern of the investor and still provide the kind of asset class that some of the investors would probably like to have in their portfolio for long-term asset price appreciation and accrual.
True. Suyash, your views on this, please.
Thank you. So, let me start at the beginning. Let me start by, sharing our perspective on why do you need debt in the first place. And I think both, our Dheeraj and Sridhar, refer to that. See, basically, economic and financial market cycles follow boom and bust. And this will happen. This has happened, through the years, and it will happen for as long as investing and, economies sustain. Now, to navigate a boom and bust cycle, and which is going to be a periodic truth of life, you need an asset allocation table that has both pro-cyclical and counter-cyclical assets. Now, pro-cyclical assets are those that tend to do better when you're in an economic upturn and when financial markets are reviving. And counter-cyclical assets are your nest egg. So when the chips are down, when you are in a bust situation, it could be a local bust. So, the kind of credit crisis India saw was a local bust, but that could happen as well. And that is when your counter-cyclical assets have to kick in. Now, by definition, counter-cyclical assets are, for the most part, the best quality fixed income. And I'm referring to fixed income more largely. It needn't just be mutual funds. It could be deposits. In a global context, it is, US treasuries, for example, but we are sticking to India here. So it is the best quality fixed income that is your counter-cyclical asset. So we think it's a grave mistake to think about debt and equity as either or. They are both part of an asset allocation table so long as boom and bust cycles will sustain. So again, to concur with the view earlier presented, you have to therefore focus on quality on debt, because that is the largest purpose that debt is serving in your table. Now you break down asset allocation to how you asset allocate within debt. And one framework that we at IDFC Mutual Fund swear by, and it has served us very well over the last 10 years, is dividing the investment portion of debt, so keeping liquidity needs aside, into core and satellite. Now, what does this mean? In fixed income, largely you take two sorts of risks. You take duration and credit risk. And core set of products are those that run constrained duration and credit risk strategies. And satellite products are those where you can take higher amount of duration risk or credit risk or both. So the bulk of your debt allocation, we think, should belong to the core bucket of products. It's nothing to do with how well or badly a fund house is managing credit. A credit is, at the end of the day, credit, right? And therefore it belongs in the satellite category. And one very key way that advisors and investors have to pressure fund houses is to make fund houses be disciplined about creating core bucket products in the first place, and to basically kind of let go of this temptation to dilute every product under the sun for some sort of a YTM chase at some point in time. And this core satellite bucket allocation has to be very strict. So it has to actually be beyond the view of the manager, and the philosophy in some sense has to govern the product. And within core, then you can have a host of products for different minimum investment horizons. So you could have, low duration money market products. You could have short-term products. You could have corporate bond, banking, PSU, and medium-term funds, which could all be for different minimum investment horizons. The one observation here I would have is that names by themselves mean nothing. So medium term run by one fund house could have a very different risk profile than a medium term by another. So there is regulatory development with respect to harmonizing products within one category, but we are not fully there yet. So you have different profiles within the same name. And second, related to this, it needn't mean that debt be used only for cash deployment. So, by doing that, you are sub-optimizing also that counter-cyclical bucket that you're holding. So a better way for us always has been to break debt into core and satellite, and to almost, whatever view we may have with respect to where we are in the credit cycle, etc., to create the core bucket of products so that duration and credit risk is always constrained in that bucket.
So that was a pretty elaborate explanation, and I'm sure investors and advisors will find these set of steps very reassuring.
Can I have a question for Chintan, Krishna?
Sure, Yes,
Yeah,
please go ahead.
just based on what he has mentioned, I mean, we find that there's been a lot of outflows in the credit risk funds of late. Is credit risk coming back in a different way through the AIF route? And in that sense, is there a higher risk to the HNI portfolios? Any views on that, Chintan?
Okay, so yes, we are seeing lack of risk appetite among mutual fund investors, leading to mutual funds vacating the space of high yield credits, also because of certain regulatory reasons. And that space again is vacated by some amount of original NBFCs, etc., also who used to probably lend at that point of time. So there is one space which is there are certain set of borrowers who are probably looking at borrowing at a slightly higher yield, but there are no lenders, and that is probably the space where category 2 AIFs are wanting to capture, where the risks are not too high, but yes, the returns can be higher. Now, category 2 AIFs, of course, in terms of taxation, are not as efficient as mutual funds because there is a concept of marginal taxation which may apply there. But if the yields are at about 11, 12, 13%, because mutual funds are not taking it, because NBFCs are probably not participating in it, and the high net worth individuals or family offices are looking at that space and wanting a platform, category 2 AIFs on the credit space are likely to pick up. But it will not be very large or voluminous, but there is a space and enough structures and enough borrowers or enough companies are there in that space for us to participate in. So I believe that it will be a niche. It won't be too big, but yes, there is a space there for category 2 AIFs.
Okay, thanks. Just one more follow-up question to Suyash. He made an interesting point on pro-cyclical and counter-cyclical buckets. So would floaters be part of the counter-cyclical bucket, Suyash?
No, actually, see the defining two characteristics are duration and credit risk. So you can construct a floating rate fund that still runs a net duration, which could be anything. So what does a floating rate fund do? It is, there are not enough pure floating rate instruments in this country so far. So for the most part, it uses derivatives to net off duration in the product. Now I can create a floating rate fund that has a net duration of, let's say, 6 months, or it could be a floating rate fund that has a net duration of, let's say, 2 years. So it is always duration and credit, which are the two defining features in our view. So obviously a product which has a net duration of 2 years also should belong to the core bucket, but with a minimum investment horizon, which is, let's say, at least 1 to 2 years. But in fact, and if we get a chance later, then we can elaborate more or discuss more about floating rate funds. This narrative that it is the, the golden key to protect against interest rate rises is sort of flawed, which one hears a lot in media these days, because of the two reasons that pure floating rate instruments are harder to come by. And whenever you use derivatives, there is an element of what is also called basis risk, which means that the derivative curve and the underlying bond curve may actually move in two different directions sometimes. So you may actually get a double whammy on both sides. So it's not as bad, but it's not as good also. And you have evidence from recent history, just so, over the last 3 months as interest rates have gone up, you can look at the class of floating rate funds and you'll find that they haven't done very well, if memory serves me right, versus, let's say, low duration products. So again, the net duration is what comes into play here.
Thanks, Suyash. Back to you, Krishna.
Thank you, Sridhar. So, Suyash, to take your answer forward, is it really worth taking duration risk at this point, given that we may not see interest rates coming down from here?
So look, first of all, let me re-emphasize. So when we speak about taking duration risk, we are talking about that 20-30% that you will allocate to the satellite bucket of products, where you are running higher duration risk kind of products. And if you're a very conservative investor, then you may actually choose not to allocate to the satellite bucket also. Now coming to the product itself, see, when yield curves are very flat. Now what I mean by a flat yield curve is that the difference between, let's say, the 5-year government bond and the overnight rate traditionally used to be, let's say, 50 basis points, right, in previous cycles. Now, when yield curves are that flat, then you need yields to fall for you to be able to take a call on buying that 5-year bond. Otherwise, there's no sense whatsoever. You can very well run a money market strategy. Unlike that, however, today, just to put some numbers on the table, a 5-year government bond is roughly at 6%, or a 5.5-year government bond to be precise, is at 6%, whereas the overnight rate is at 335. What a typical money market fund would offer you is somewhere around 4.25. Now, not for a moment in this illustrative example am I suggesting that you should buy a 5-year maturity fund for a period of 1 year, but nevertheless, I shall put this illustrative example on the table. Suppose over the course of the next year, the yield on this 5.5-year bond goes from 6 to 6.5. But in that time frame, the maturity of the bond would have reduced by 1 year, right? So the average duration that the bond will hold over the course of the year is roughly a little more than 4 years. Now, if this yield were to go up by 50 basis point, you will lose 2 rupees, which is 50 basis into 4. Whereas what you're making is roughly 6.25, which is the average of 6 and 6.5. So if you deduct 2 from 6.25, you still make 4.25, which is better than what you're making on a money market fund today. Now, again, let me re-emphasize, this is not to say that you should be buying a 5-year fund with a 1-year horizon. It should always be for a 3+ year horizon. But the simple point is that the yield curve is so steep that you have to think about the market in 2 ways. One is what will happen to the overnight rate, which is artificially low and therefore needs to go up. And 2, how much of that will get transmitted to, let's say, the 5-year point. Now, the other caution I'd put on the table is this does not mean that you keep buying a 10-year, 15-year bond also on the same logic, because at some juncture, the duration risk that you take overwhelms the excess carry that you're making. But the answer is not as simple as it's meant to be many times, because the yield curve is so steep. So the last quick point that I'll make there is that when curves are so steep, the question you really have to ask yourself is, how much do yields need to go up so that the excess carry that I'm making gets entirely wiped away? So if a repeat of January, February were to happen, then obviously this trade entirely fails. But as long as you think that the pace of yield rise is going to be measured, with a 3+ year horizon, intermediate duration products should make sense between the core and satellite buckets.
Quite comprehensive. Okay, so yes, Sridhar, you have a follow-up question?
No, that's it. Sorry.
Okay. So there's another question which a lot of people have been asking nowadays. Dhaval, we would like to know your perspective on gilt funds and your view on where these yields are headed in light of the fact that we have 12 lakh crore worth of borrowing lined up during this financial year. Then interest rates will probably not reduce from here on, and the fiscal deficit situation is such that it will widen quite a bit this time around. So what are your thoughts on this?
Yeah, so these are valid concerns, but let's get the facts on the table. See, in the aftermath of pandemic, we have seen the global fiscal deficits going up dramatically. I think almost all developed countries are pumping a lot of liquidity by way of borrowing money. The global debt levels have been going up and at a record level. On the other side, the central banks are also buying bonds at the record level. And by current measure, the central bank balance sheets to GDP ratio is at all-time high. You also have significant amount of liquidity in the banking system, and the interest rates have remained artificially low by some measure. So what we are observing right now is some sort of like a fiscal repression, where investors at the short end are worried about the prospects of inflation, or in some measures, inflation is already there for countries like us and some of the other emerging market countries. However, the yields at the short end has been kept artificially low. with a view to support the economic growth. So while investors are looking at the gilt fund and they're thinking about the trajectory of the bond yield, I think there are two sets of investors or the thought process in the market. On one hand, we are seeing extreme strong view that basically is trying to communicate that with so much of liquidity in the banking system, it could possibly inflationary at some point of time, and then the inflation could possibly go up significantly, and then thereby asking central banks to go and hike rates in order to contain inflation. However, there is also another school of theory who tends to believe that the world is in a deflationary phase, and because of the demographic profile, because of the advent of technology, and because of the other factors which have kept the inflation under check, they believe that the inflation probably be transitory. That means after going up because of the base effect, it will probably come back. So in that kind of thought process, I think these are the two pros and cons which are governing the market. But currently, if you look at the bond market behavior, I think the recent hike in bond yields in the US perhaps is on account of the fastest economic revival after the pandemic. And I think market has adjusted to a level where they believe that the economic recovery has happened, and now a US economy is possibly out of the pre-pandemic, at probably closer to the pre-pandemic level, and has wiped out all the kind of losses that was incurred because of the pandemic level. From here on, I think the market will start pricing what could be the trajectory of the inflation. As far as India is concerned, we believe that now we are facing the second phase of COVID. Market participants are trying to gather or gauge the impact of that on the government finances as well as on the outcome of the businesses. I believe that, as Suyash rightly pointed out, the rate cut cycle is probably over. Now we are getting into a trajectory where the bond yields are likely to remain stable for a longer period. We don't know whether that will take 1 year, 1.5 years, 2 years. But the Reserve Bank of India has very clearly articulated that they are not going to embark on a rate normalization cycle until the economic recovery on the firm footing. So from that perspective, we do not expect the RBI to start tightening the rate cycle or normalizing the rate cycle. But with the kind of borrowing that we are seeing, I think it will probably be also important to figure out the trajectory of the bond yield. Our view is that with the steepness in the yield curve, as Suyash has pointed out, it's so high, it's multi-decade high, that the bond yields and the long end will probably muddle through right now or remain in the range for the next greater part of the year before they will start taking into account the change in the RBI's monetary policy and tend to react to that. But I firmly believe that for the next 1.5, 2 years, until the economic recovery is on the sure footing, we are going to see bond yields on the long end muddling through in absence of the RBI normalizing rate cycle.
All right.
So Dhaval,
yes.
Yeah, I have a follow-up question on this. So we have seen that Gsec funds with 10-year constant maturity, that's around 2,000 crores in the industry. Gilt funds are about 16, 17,000 crores. Dynamic bond funds about 25,000 crores. It gives a confusing picture. What is the best way to play the gilt funds, according to you? Mix of dynamic bond funds or pure play gilt funds? And despite all the efforts of government to encourage retail participation, nothing is taking off. What's your view on the best way to play this?
See, if you are trying to capture the movement in the yields, then I believe that the dynamic bond fund will probably be a better strategy between the constant maturity 10-year and the dynamic bond fund. Having said that, when you make an investment, you are also trying to concur with the fund manager's view with your view. What if you are having a bullish sentiment with regards to the movement in the 10-year yield, but the fund manager is not ideally positioned to capture the movement in the yield? So in light of that, the best probable strategy in our view is to look at a product like Bharat Bond ETF 2030 or 31, which has a very, very defined asset allocation. And they run the passive strategy. So you know at every point of time what is going to be the duration of that product. And they will probably be the best kind of vehicle to capture any kind of downward move shift in yield that would probably take place according to your expectation. Just to give numbers, in month of March, when the entire market was focused on the volatility in the bond yields. And that point of time, the greater conversation among articulated investors was that whether we are seeing a structural increase in yields or not. The month of March, particularly in the second half of March, we have seen a rapid decline in bond yields. And at that point of time, the products like Bharat Bond ETF 2030 and 31 have delivered absolute return of 2.5% in 1 month. Absolute return. So no other actively managed funds have been able to deliver that kind of returns to clients. So I believe that when an investor wants to take a tactical call, they will probably have to find out which kind of strategy will provide them with the maximum bang on the buck.
Sure. I think that is an interesting segment for which I think Dheeraj has a lot of questions on the bond ETFs and passive funds. Thanks for that, Dhaval. I wanted to ask Suhash if he has any comments to make on this, on Gsec. What do you expect the Gsec yield?
So, active managed products, like I said, belong in the satellite bucket. So would a passive product, which is running a higher constant maturity, because your starting duration that you're assuming is quite large. There are, by the day, more options evolving for the passive investor or an investor who does not want too much of a fund manager intervention. So a lot of mutual fund houses, including ourselves, have recently experimented with index products. So those are products which are also meant to work in a passive manner, in a low cost fashion, to provide participation at specific points on the curve. But the important thing to recognize there is that the starting duration on these products is also very large, and therefore they concretely belong in the satellite bucket of allocations. So I think one of the most important things about fixed income investing, you spoke about the credit episodes that plagued us between 2017, 18 to 2020, let's say. To me, the most remarkable aspect of that wasn't that a few credits got busted. The more remarkable aspect was, why did it cause so much large scale pain to investors? Right? So if you remember, duration products have busted multiple times. And they have caused so much of heartburn, but they haven't wiped out parts of capital or significant chunks of capital of an investor's book. And that has happened because of over allocation, probably. And which again points back to the absence of a robust asset allocation model. It points back to the fascination that every product has to deliver, handsomely on returns before it gets selected. And one final thing about, this positive real return theory. So yes, real returns are, I'm sorry, I'm deviating very sharply from your government bond question, but I thought, it's important to address this. Real returns are a challenge because we are in the phase of an economic cycle where the economic cycle dictates that the consumer and the investment maker should be compensated. There will come a time in the future when it's back to being the saver's turn. Having said that, we tend to have very short memories on things like these. The period between 2013 to 17, 18 was probably the best time for quality fixed income beating average inflation, right? And that is when the most over allocation to credit products had happened. So again, sometimes when we say that, if 5% yield hypothetically on a quality product is not enough because inflation is at 5.5, there are two problems with that argument. One is that real yields are always versus an average expected inflation, never on inflation that has already occurred. And in a country like India, it's very difficult to figure out what the average expected inflation is. And second, history suggests that no matter what the real rate on offer is, we have had this penchant of forgetting a robust asset allocation table and just allocating in favor of what the flavor of the day is. I mean, we have seen our own experience over the last 1.5 years as government bond funds have done well. A lot of direct retail applications are coming to government bond funds. Right now, I get worried because I don't think that these are coming because of an asset allocation table whereby the investor is consciously choosing to invest 20% or 30% of allocation to a government bond product, while fully recognizing that these are subject to extreme volatilities. My suspicion is they are looking at last 1 year, 2 year returns and jumping in. So I think the biggest service that the advisor community can offer to the client is an asset allocation table, and to continually challenge the fund managers or the producers that you better provide me a set of products that qualify as core asset allocation, and then you better not tinker around with the risk profile of those products. But hand on heart, how many times have these questions been asked? In fact, the go-to argument is, oh, debt doesn't do well, let's just avoid it altogether. Believe me, you're sub-optimizing your overall return by taking that line of thought.
Thanks, Suresh. I have a question for Chintan. We have this massive $1 trillion printing bills handed over by the Fed, and most of the equity markets in the world have been beneficiaries of this largest Gsec coming. Is there anything that we should worry about the taper tantrums whenever the withdrawal mode starts for the Indian bond markets also?
Yeah, so I think the key over here is, and I think the last 10 minutes of discussion has had a lot of elements around inflationary environment and Indian bond yields, and the question on international US printing. US has printed about $3.5 trillion on its way to print another $3 trillion. The Fed's balance sheet has its highest, as was mentioned earlier, and this at some point of time will have to be tapered down. The last comment from the Fed Reserve has been that they will continue as long as it takes. But the point being, at some point of time, next 12 months, 18 months, I would say, they will probably have to lower their bond purchases, and maybe in the next 24 months increase the rates. Should we be worried in India? I think the differential between Indian interest rate and US interest rates is already large. We never fell. Yes, for a brief moment, we did see our bond yields come down sharply, but our bond yields are reflective of a normalized environment. Unlike in US, where the bond yields went to as low as 55 basis points in August 2020, and now they are normalizing. I think they've touched about 1.65. So when Fed does start to increase rates, that's when we will find bond markets obviously get pained, and equity markets probably will be pained even more. And before that, of course, what will happen is with all the money printing that is happening, and unlike in 2008, the distinction which I'd like to make is in 2008, the money printed by the Fed went into plugging the holes which were filled for the coffers of the banks, so to say, the US banks, which had the problems, the Washington Mutuals, the Freddie Mae, Fannie Mae. Right now, this time around, when the pandemic struck, the loss of income for the people who got hurt was about $500 billion, but the government in US has pumped in $1.5 trillion in their hands, and which has led to the demand push or the spending spree, which will in turn ultimately showcase into commodity prices going up. Aluminium today hit a 10-year high already. We are seeing corn and cotton prices also going up. So agricultural commodities, base metals, steel, if everything is going up, inflation will rear its head, which is good for equity markets, of course, in the near term. But in the longer term, it will hurt both bond markets and equity markets, and hence probably some allocation to gold may also make sense from a safe haven perspective. So just to round up, yes, when US is going to print so much money, the first leg will be that we will find a lot of money coming from West into India. It's not happened on the debt side in the last 1 year. Debt has lost money, but equities have seen 250,000 crores coming in. I expect that debt money will also come in at some point of time, which will keep a lid on the yields. But after 12 months or 24 months, when Fed finally raises rates or indicates raising of rates, that's when equity and bond markets both will probably see a bit more volatility.
Thank you so much, Chintan. Appreciate the insights. My next question is for Dhaval, because we've been just speaking about US Feds and how and what they have been doing. Dhaval, my question to you is, SEBI has circulars now on the 81 bonds, right? And you see these yields shoot up because of the 100-year maturity. Now, a lot of AMCs have invested in these bonds, right? So how can we regard this in terms of a headwind for an asset class? And what should investors perceive this as?
So suddenly, this is something what you call an event risk. That the AT1 bonds it's a valid instrument across the world, and I think all banks tend to issue some sort of like an AT1 bond in order to bolster the tier 1 capital, and they are widely traded, widely invested, widely recognized instruments. However, with regards to in India, I think Indian bond market and market participants, both on the HNI side as well as on the mutual fund side, had a special fascination for AT1 bonds, primarily because they were issued by banks and predominantly PSU banks. And at that point in time, there was certain amount of expectations, and there is still continue to be an expectation that generally, looking at the history, these bonds always tend to get called. And as a result of that, investors don't have to keep these bonds on their books for a longer period. However, in the aftermath of the episode of Yes Bank AT1 issue and after the regulatory checking, I think it was revealed that the market participants are pricing these bonds as yield to first call, without any kind of assurances from the issuer whether these bonds are going to get called or not. So in light of that, I think SEBI realized that its AT1 bonds are sort of like a hybrid bond, similar to like your InvITs and REITs, wherein in generally, if you look at the InvITs and REITs, what's happening is that they are giving you equity-like volatility in terms of price, but giving you bond-like returns. So somewhere down the line, if you accept that argument that AT1 bonds are sort of like a hybrid instruments and they're behaving like InvITs and REITs, then clearly it basically gives you a sense that AT1 bonds price volatility could be significantly higher. And as a result of that, if that is the kind of 40-50% annualized volatility in price that you are going to witness because of the change in the price or valuation methodology as suggested by SEBI, then clearly I think mutual funds are going to have a relook at their further investment in AT1 bonds. At present, as you know, that there are about ₹1 trillion worth of outstanding AT1 bonds. And I think the mutual funds are holding about 30 to 35,000 crore on their books as far as Feb end data is concerned. But important test is going to come in FY22, wherein we are given to understand that about 30,000 crore worth of bonds, AT1 bonds, are going to be ready for exercising of the first call. And I think market is awaiting with a bated breath whether the underlying banks exercise their call option or not, because right now, as you know, that banks are still reeling under the pressure of higher level of NPAs. The government still is pumping capital, equity capital in some of the PSU banks, and AT1 bonds are providing the most efficient risk capital, equity risk capital to banks, because the interest payment is tax deductible. So when a bank issues an AT1 bond, it's a 9.5%. Their real cost is somewhere between 6 to 7%. So they are raising an additional tier 1 capital at 6-7% as compared to an equity capital between 12% to 15%, depending on the market's expectations of the equity risk premium. So AT1 bonds being the cheapest form of equity capital, and it remains to be seen whether the banks and their management, and given the recent change in RBI's guideline with regards to the calling of AT1 bonds, depending on their capital ratio and other things, they live up to the market's expectation in form of exercising the call. If they don't, then as per the current methodology, the bonds will have to be valued back to 100 years. And that probably will be a little bit of adding to additional layer of volatility, in our opinion. Having said that, I also believe that AT1 bonds are a valid instrument. And somewhere down the line, I think, once again, as I mentioned during my answer to the credit fund, just like credit fund, AT1 bonds are also valid instruments, and banks will need that kind of instruments to be issued. Now, if mutual funds are not going to be able to purchase this, clearly HNI investors don't have that kind of appetite to absorb large amount of supply of AT1 bonds. So somewhere, I think when the dust settles, I think everyone will have to get together and figure out how the way forward to be able to absorb the AT1 bonds again in investors' portfolio.
Thank you. Thank you so much, Dhaval. My question now actually moves to Suyash. We spoke about the AT1 bonds, which is towards PSUs. We spoke about REITs, which is more the private players. But there's a lot of activity right now in the passive debt fund space, right? This structured products, especially around your central and your state loans, right? So where does this fit into a client's portfolio, and what percentage of allocation?
I lost you there towards the end, but I guess you are asking what percentage of allocation should go there.
Not in the AT1 bonds, but what we were talking about is there's a lot of activity in the passive debt space.
I heard that,
around
yes.
Central and state governments. Yeah.
Look, what ultimately are passive debt funds? They are basically a fund constructed with very little leeway given to the fund manager, right? So we have in fact been doing variants of this for the last almost 10 years now, and with reasonable success, which is to say that it goes back to the theory of asset allocation in fixed income, that fixed income is the nest egg. Fixed income is what should give you a basic running income when the chips are down. So, you could think about a passive product as a product that reduces the scope of fund manager intervention, that runs around parameterized criteria that are almost upfront committed. And to that extent, they are globally a very valuable tool for fixed income allocating. They also, sometimes we exaggerate the role of alpha in every asset class. Over time, as we see, alpha becomes harder and harder to come by, partly because of the nature of markets where there is a very large move towards upfront discounting. In fact, part of the discussion you guys had earlier with respect to the Fed, there also, there is an element of upfront discounting that needs to be kept in mind. But staying on topic, so passive investing is here to stay. Passive investing in fixed income, if this is the way that more fund managers will create core bucket products where the element of risk taking is controlled, it's parameterized, then that's exactly the way this has to evolve. And the other advantage is that you are not at the mercy of fund manager alpha, that that the parameters of the product won't be changed midway. So why it should infuriate you if a fund manager changes parameters midway, that if you are actually a follower of a core satellite principle, you are basically monitoring your allocation in terms of the total credit and interest rate risk that you're carrying. Now, till 2-3 years back, we used to find even a low duration product suddenly used to ramp up maturity. Now, till it was doing well, it was all good with everyone. But that was the first alert sign that you should have basically taken on and acted upon, that your asset allocation table has gone for a toss, because one of the products underlying that asset allocation table has suddenly changed its risk profile. So while the going is good, the fund manager gets a lot of pats on their back and more allocations come through. And when the going turns, then the blame also goes that way. And no doubt the blame rests there as well. But I think much lesser responsibility is taken by the allocator than it should be, if I were to be truthful. So passive investing that way helps you build an asset allocation table, safe in the knowledge that the fund is almost protected from the fund manager. And again, passive funds could be at any duration bucket at all. So we've been doing these roll down products for the last 5-6 years. We have run a short-term bond fund that is pegged around the 2-year average maturity point on a portfolio maturity basis. And these kinds of adherences we've been following for a very long time, in order for investors to actually have a suite of core bucket products that they can invest in.
Thank you.
So, all right, gentlemen, it's been a very engaging session so far, and it's now time to amp up the speed a bit and start off with a rapid fire round where there will be 4 questions asked to our 3 panelists, and would request them to give a brief and decisive answer for the same. So, the first question is that which factor can upset the credit or interest rate environment in India? We start with Chintan.
I would guess inflation.
Okay. Suyash?
Of imported tightening, which is that the RBI is disallowed the luxury of unwinding at its own pace because global interest rates kind of force their hand, though we attribute a very low likelihood to that.
Okay. Dhaval, what do you think?
See, in my view, I think it's the government policy. Right now, as you finally, after a couple of years, we have seen government being pro-growth and trying to create employment and other scenario through budgetary expenditure on capital and infrastructure. If tomorrow, if the government changes its stance, I'm not sure whether the RBI will play the ball. And that will probably add the biggest level of uncertainty.
Perhaps. So the next question is to generate alpha, what would you prioritize at this juncture? Risk in terms of credit, or would you want to play on the duration side? We start with Suyash.
Look, alpha in the pure sense, by definition, almost in India can be had only through duration because you have to be able to sell what you're buying. Credit is a one-time selection. Part of the alpha there is also at risk that if down the line your assumptions change, that alpha can get destroyed very sharply. Second, in some ways we measure alpha wrongly in that asset class because we don't account for the illiquidity discount that credit paper should have. In the current environment, we are not even accounting for the fact that even the AAA or risk-free curve is very steep. So when we measure credit spreads in the current environment, we forget the fact that let's say a 2-year corporate bond yield minus a 1-year corporate bond yield is at 65 basis point, used to be 20 basis points. So, alpha is hard to come by and often measured wrongly. So if you have to pursue alpha, you by definition pursue something that you can buy as well as sell and not just be at the mercy of one-time selection. But again, it's concretely in the realm of satellite category allocations only.
Okay. Dhaval, your thoughts?
I think it's very clear that currently, given the steeper shape of the yield curve, it's duration. But at some point of time, we have always seen that credit will also come back into the picture if this financial repression continues for many more time.
Okay. Chintan, what do you think?
So we clearly think that it's a mix of both. Stay in the middle, neither too low on duration nor too high. And as far as credits are concerned, clearly you don't go down the curve, but in the middle itself, the AA spreads for many of the good corporates are also good. So if you stay in the middle category for duration and credit, I think so-called elusive alpha can potentially be got in debt as well.
Correct. So my next question is, how would you rank instruments in order of preference, short-term debt, medium-term debt, and long-term debt? So we start with Dhaval this time.
I think my preference will be initially medium, and I'm defining medium as my first preference between 5 to 10. Okay. From after that, second will be long, which is 10 to 15, and the third will be short because of the overcrowded nature and risk of negative real return over the next 1 to 2 years.
Correct. Chintan?
Yeah, so our preference is clearly the dynamic duration category where we can change it, but if I had to pick, it would be medium followed by long and then short. So in line with what Dhaval has mentioned.
Okay, Suyash?
So I'll define short and medium as between 2 and 4 or 5 years and largely focused on AAA and sovereign. So 60 to 70% short and medium in line with the core satellite principle. 20 to 30% in active duration. We don't like long-term debt at all because it's a 5-7 year bloated fiscal cycle we are undergoing. And if you think about it, probably 5 cross 10 is actually too flat. We like steepness up to 5, 6, 7 years of the yield curve. But beyond that, our view would be that fiscal risk sort of greater issue And the additional duration risk that you have to carry for the additional steepness that you capture is just not favorable.
All right. So that brings me to the last question of this round. The consensus largely believes that the best days of debt mutual fund investing may be over, at least for now. So do you agree? And please state a reason behind that. Suyash, if you can continue answering this, please.
Well, if it's time to junk asset allocation tables, then yes. If it's not, and if, let's say bank deposits are not degrowing by 50% year on year, then you know that, it's not. Yes, returns from debt in the near term are going to be lower. But the principle that it's a counter-cyclical asset. And so if your view on the economic cycle is that it's turning, you can tweak the asset allocation on the margin, but you don't abandon it altogether. So I honestly don't know how to answer that question if you ask me.
Okay. Dhaval, your thoughts?
So if you are asking me best days of debt, means are you talking about debt mutual funds?
Yes, as of now.
Oh, I
Because
believe
a lot of, yes.
I believe that after being in the market for more than 23 years, I think we are embarking on the second version of the bond funds through passive funds. I think there was a fair amount of discussion on passive funds. We are a big proponent of passive funds, and I believe that the passive funds will probably be the only vehicle through which we are going to get retail money back into the mutual funds. At this point of time, bulk of the money in fixed income fund is institutional and HNI with very little retail money. But one of the principal point about the passively managed fund through target maturity bond ETF structure is the predictability of returns. And I think once the asset starts getting popular, we are going to see retail investors start coming into mutual funds, and we are going to see their participation increasing. And in the next 5 to 10 years, I'm fairly confident that the bond fund size will double.
Okay. Chintan, your opinion, please.
Yes, I'll try and make it a bit funny since it's the last question, maybe on the fun side. If it was going to degrow the mutual fund space, then the AMCs wouldn't be getting 50 Ps. Most of them are, or they are on the verge of getting. That's on the lighter note, of course. The space itself, if I look at from a comparative with banking, 150 lakh crore of deposit versus we at being at about 25 lakh crore, 1/6 the size. In US, it's the reverse, right? The mutual fund industry is 4 times the banking size. We may not reach there, of course, but still, I guess if the third part of the point that if we are going to grow to $5 trillion and our savings are going to be higher, even if I take 15% savings of the $5 trillion, that's about $750 billion. People will put that money somewhere, and with the growing intermediation, growing financialization, growing digitalization, where we have a lot more people now selling mutual funds and understanding mutual funds, coupled with the obvious benefit of taxation that exists, there is no doubt that mutual fund on the debt side will grow. In fact, the largest mutual funds will be the one which have a strong debt background. And that's been the case in the past since I've joined in the last 15 years, and that will continue, I believe. Thank you.
All right. So that brings us to the end of what has been an extremely comprehensive discussion on a particularly relevant topic in today's times. And I would like to take this opportunity to thank all our panelists, that is Suyash Chaudhary, Dhaval Dalal, and Chintan Haria, in addition to our iFAST advisors, Sridhar Sattiraju and Dheeraj Shetty, for being so generous with your time and perspectives. A big thank you to all of you who tuned in to watch this session, and we shall look forward to connecting with all of you pretty soon with another relevant topic on this iFAST Advisor Insight. So on that note, it's time to wrap up. Thank you once again for tuning in, and take care.